What if I told you the $360 billion AI infrastructure boom could trigger the next financial shakeout, and the first warning signs will hit microcap stocks?
Today, we expose how circular deals between NVIDIA, OpenAI, and Amazon create a bubble risk that every small-cap investor needs to understand fast. This isn't just a tech story, it's a forensic analysis for anyone in early-stage growth stocks.
But first, you need to understand why microcaps are the market's early warning system. They're the canaries in the coal mine. Just look at the warnings from the top. The International Monetary Fund is warning that AI stock valuations are approaching dot-com bubble levels. And this isn't just theory. Morgan Stanley has already advised clients to sell small-cap stocks, noting the market's dangerous concentration in a few AI giants. The pain starts small, long before blue chips even flinch.
What does that mean exactly? Why do they get hit first?
Three reasons. First, liquidity. When big investors panic, they sell the riskiest, hardest to sell assets first. That's microcaps. Selling pressure builds here before blue chips even flinch.
So it's a flight to safety.
Exactly. Second, economic sensitivity. Small companies have less cash and depend on loans. A slowdown or credit crunch hits their earnings hard and fast. Third, investor psychology. A microcap sell-off is usually the first sign sentiment is shifting from greed to fear. If you track these stocks, you see market danger before it goes mainstream. So what's the red flag the Canary is warning us about right now? Circular financing, the biggest risk in today's AI infrastructure boom.
Let's map the money. NVIDIA invests in CoreWeave, who then buys billions of NVIDIA chips. OpenAI, a customer, invests in CoreWeave as part of a $22 billion cloud contract. Amazon does the same dance with Anthropic.
And those circles get even tighter. Small microcaps in the AI supply chain depend on this cycle to survive. When the music stops, they're the first to fall.
What proof of how this narrow rally leaves small caps exposed? Look at the advice from the big players. Morgan Stanley is telling its clients to sell small caps now, fearing they'll be the first to fall when the AI music stops. This isn't a niche fear. The Bank of England has flagged an AI equity bubble as a top threat to global financial stability. The warning signs are in the macro data, not just a single stock.
So let's protect your portfolio with forensic analysis. Here's your microcap bubble checklist. Revenue dependency. Is your company hooked to one circular mega deal? Vendor concentration. Are sales dependent on one big tech player? Infrastructure bottleneck. Are power grid or CapEx delays leaving your stock exposed? Financial leverage. Are investments in assets being round-tripped just to inflate numbers? Backout clauses. What's the exit plan if a big player leaves? Check for phrases like performance-based investment, revenue minimums, CapEx commitment. Those are classic forensic warning flags. Don't panic.
Learn. The picks and shovels microcaps selling cooling tech, energy management, grid software, they're not betting on one AI winner, but on real demand from the boom itself.
Infrastructure REITs, green energy microcaps, companies with clear, transparent books, these are the hedges that have survived past bubbles. If you only remember one thing, bubbles start big, but pain hits small first. Microcap investors are the canaries for systemic risk. Pause right now. Do any names in your portfolio depend on circular deals or one mega vendor? Type them below, then watch for our closing checklist.
We want your stories. Comment below if you've seen circular financing or vendor risk in your microcaps. Let's crowdsource a forensic warning checklist for everyone watching.
Next week, we'll ask, is there an even bigger bubble waiting to pop in the AI ecosystem? Subscribe for deep dives so you never miss the red flags or the hidden opportunities. Stay skeptical, stay forensic.
See you in the next one.